Podcast is now starting. All attendees are in listen-only mode.
Welcome, everyone. We're glad that you are with us today. Today's webinar is going to be on the trifecta, the opportunities for universities, corporates, VCs to work together on commercializing new technology innovation. My name's Kate Humphreys, and I would just like to walk you through a few things before we get to today's webinar. We will have another webinar in 2 weeks on February 28th. It will be with David Horowitz, the CEO and founder of Touchdown Ventures. If you'd like to see any of our past webinars, you can find them on YouTube, and the address is right here. At the end of today's presentation, we will have a chance for some questions. If you have a question you'd like to ask, we ask that you put it into the control panel, and we will collect those and go over them at the end of the presentation. Today's presentation will be recorded, is being recorded, and we'll send it out. It usually is posted on YouTube within a day or two, so you'll be able to review it and share it with anyone else who you think would be interested. So again, welcome. Thank you for joining us. Today's webinar is on the trifecta, opportunities for universities, corporates, VCs to work together on commercializing new technology innovations. I'd like to introduce today's speakers. We have Steve Sokoloff and Vicky Scarborough. At this point, I'd like to turn it over to Vicki, who's going to give us a little bit more information about the Startup Development Program.
Good afternoon, everyone. This is Vicky Scarborough. INSET2 is a startup development membership organization for corporate open innovation programs where we develop and create and start and fund startups that align with their corporate needs. INSET2 has been around a long time. However, in the last several years, we've really created this startup program. We vetted it through a number of road shows, if you will, through a number of VCs and universities and so forth. We proposed a model, which I'll show you in a minute, that is really working well for us. We had our first congressional briefs in 2016, and then we had a pilot of our demo day, which brought startups to Congress. We had a second demo day early in 2017. We announced a new program called IP to Startup, which actually allows for universities to submit their intellectual property to be vetted by corporate membership. And then we have now our newest program, the Startup Development Officers Program, in which we have people from corporate life or VCs or other business activities who are volunteering to serve as members of startups to help them get off the ground and become successful at commercializing their technology. On the next slide, we have the really what we call our model. And here we have the federally funded monies that come in through the government that go to the universities, which create our startups. And then that goes in through the university programs, which eventually there is either intellectual property that's created out of some of that funded research or a startup. And as that is created, members to INSET2 have the opportunity to vet the submitted either IP or startups from the universities to us, and we will vet it and then determine whether or not it has value. There's funding along the way. We have angels and VCs in our network that can help fund some of these startups. And eventually you would hope that they would go through to either a business unit, to a large company, or perhaps even be an IPO. So the whole goal here within INSET2 is to connect, as Steve is going to talk about, the trifecta. and that is the universities, the corporates, and the VCs together to make a commercialized venture. Next slide. In the venture, there are stages, and the stages we call commercialization readiness levels, CRLs. So when you have an initial idea, it starts at 0, and then it moves through a series of stages. At 1, you're really at the beginning, where you're doing startup, you're trying to figure out what your milestones are, and there you may have a little funding from the university, you may have some SBIR money, and then you move through to develop business plans and milestones. You de-risk it through scale up and works like concepts. You try to get it through to a manufacturing process, which brings you up to a 4 to 5 level. Then you begin to develop products and operational launch stage, which takes you into a 5-6 range. And when you start selling and developing revenues, that's when your angels and VCs become more interested, because now you have something to sell and can bring returns back to their investment. So these CRL levels are very important for people to understand where you are in your process. And in our process at INSET 2, at the beginning, we're asking universities to submit their intellectual property to be vetted by our corporate membership, and to allow our startup development officers to review it. Perhaps there's an opportunity to form a startup in which they can become involved. And then we have our demo day, where your startups can be viewed by our corporate membership as well. And after that, we would then move them through the system to bring them to a stage where they would be either funded by a larger company or a VC, and they may move in through an exit or an IPO. Next slide. So the demo day, speaking of which, is coming up. It will be May 1 through 2. It is, registration is now open. You can go to inset2.org and register for the 2018 annual conference and be a part of this. If you have never attended, we certainly would love to have you there. We would, if you're just now understanding what all this is about, this was a great way to see it in action, and we certainly invite you to attend. And so here at the conference, you will see, how the demo day works, and how the IP to startup works as well. So there's 2 different programs there. And our startup development really shows how our system is triple vetted. That is, it's vetted by the university who submits it. It's vetted by our startup development officers who determine whether or not there's something of value there. And our corporate membership is actually the key to the whole process, in that they're creating pull rather than push on the technology, because they only want to see what is of interest and may provide value in their markets. Next slide. So the submission, if you are interested in participating in the demo day for either intellectual property or for a startup, is March the 2nd. So that date's coming up very rapidly. And so if you have either a startup or some intellectual property that you're interested in sending in, all the instructions for doing so are on our website, and you can submit and then be a part of the May 1 and 2 conference. We'll also be at Autumn, which is the Association of University Technology Managers, which is in Phoenix next week, February 18 through 22. We have a booth there this year for the first time, and Tony and I will be there, along with several others who will be available to meet with you and talk about this university IP, the startup program, and as well as our whole startup development program in general. So we're there to really talk to the universities and have them, get them to understand a little bit more about how we can help them be successful in their efforts. So I believe Steve Sokoloff is now going to talk to us about the Trifecta, the universities, the corporations, and the venture capitalists. As we mentioned earlier, Steve is a venture capitalist and serial entrepreneur and has a lot of experiences in this area, and I believe that you will find his talk very valuable. Steve?
Thank you, Vicki. So can everyone see my slides? There, I think we have it now. So just to briefly introduce myself, I'm a partner, and you see my picture there with my colleague Jim Gunton. And Tech Council Ventures is based in New Jersey. We focus on investing in the Mid-Atlantic region. And we're a multi-sector fund, so we're investing in both healthcare and technology opportunities at an early stage. We have a lot of experience in technology commercialization and in partnering with corporates. I've probably done 70 or 80 investments with corporate partners. And our firm has a very unique relationship with the New Jersey Technology Council, which is a really vibrant technology industry association that provides us the leverage of its 1,000 corporate, university, and service provider members. So it makes for a great network for deal sourcing, diligence, and partnering for the development of opportunities. And we're on our second fund. Our prior fund was extremely successful, top 5% returns to investors. So to share a little perspective on university opportunities, universities offer tremendous research resources. According to the National Science Foundation, in 2015, university research spending totaled about $65 billion. And just to contrast that with a couple other benchmarks, the total venture capital investment in 2016, I had data a year later, but comparable, in 2016 was $69.1 billion. So just about the same size as total university research spending. And the early stage venture capital investment totaled about $30 billion. So less than half of the amount of money invested in the entire venture capital market early stage is relative to university research spending. And interestingly, if you look at half a dozen of the top technology corporations, and there happened to be some data in R&D magazine aggregating Apple, Cisco, Google, IBM, Intel, and Microsoft, those 6 companies total $65 billion in R&D spend. So interestingly, about the same size as the university system. And that R&D spend is leveraged by or leverages about $600 billion of revenue. So I thought that was an interesting benchmark relative to the leverage that amount of research spending can provide in terms of commercial business. So universities are increasing their focus on startups. This is some data from the Brookings Institute that shows the number of startups initiated in universities through 2012. I didn't have data after that, but I'm pretty sure it's increased, continued to increase since then. And I think universities are doing this for all kinds of reasons. It provides educational opportunities for students and faculty. It provides pathways to jobs and careers. It creates excitement for attracting faculty and students to the university. It's an opportunity for value creation, say in contrast to IP licensing or other areas. It can help build a local commercial ecosystem around the university that actually can lead to economic development and in a longer term sense, a potential for endowment contributions as these startups are successful. But university startups do face challenges. Often the technology has promise, but it's not commercially ready. It's very early. Student and faculty entrepreneurs associated with university startups are inexperienced. University startups are often not really connected well to customers at an early stage, and they're unable to raise adequate financing to really develop the opportunity successfully. So the question is how to overcome these challenges. So corporations have adopted the open innovation as a strategy. And Hank Chesbrough coined the term with his book, Open Innovation, almost 20 years ago. He subsequently published Open Business Models, and he's done a lot of other writing since then. But this adoption or embracing of the notion of open innovation by corporates can be seen in the growing number of corporates using venture capital to enable them to invest in and partner with innovative startups. And here's some data from Global Corporate Venturing that shows the number of active corporate venture capital units over the last few years. And that's grown, tremendously. It shows in 2016, almost 1,000. I was just at a gathering of the corporate venture capital community a couple of weeks ago, where data was presented that there are now about 1,200 active corporate venture capital units. So it just indicates the interest that corporations have in working with innovative startups. And this is not limited to technology industries. These corporate venture groups really now span every sector, and you can see just a sampling there from materials, consumer, automotive, energy, all the way across to technology companies on the right. So it really spans every sector in the US. And they actually represent a growing share of investment in the whole venture capital marketplace. In 2016, deals involving corporate venture was almost half of the total venture capital invested. So they've gotten to be very substantial participants in the venture capital marketplace. And why are they doing this, and what can we leverage through their interest? So they're doing it because they're trying to identify and understand disruptive innovations to their businesses. They want to explore new markets. They're bringing new products and services to market through their channels. They want to develop and leverage new capabilities. They want to expand their ecosystem and support external market drivers that can enhance their revenues. And occasionally they'll even commercialize and scale an internal innovation through a spin out. And what can portfolio companies benefit from an engagement with a corporate venture capitalist? I mean, one is, corporate venture capital has a strong presence in a market and can present market intelligence on industry trends and customers. Obviously, a corporation can represent a large customer or channel opportunity. A corporate partner can provide resources to help develop and commercialize your products or services. You can reach additional customers and markets through corporate channels and go to market. And the corporation can provide financial resources and direct investment to help scale your business. And in the end can lead to a successful M&A exit as well. The corporates are going earlier and earlier. Traditionally, years ago, the corporates relied on the VCs to scout deals and bring them in when it was appropriate. But corporates are reaching out directly themselves now. They're looking to identify and find entrepreneurs directly. They're doing a better job of exposing their investment interests publicly to attract deal flow and attract entrepreneurials who think they've got an idea that fits the corporate interests. They're becoming more open to and seeking earlier stage deals. They're figuring out how to partner with early stage startups through proof of concepts, trials, and joint business activities. They're getting involved in accelerators, either by creating their own or participating or sponsoring in third-party accelerators. And they're very aware that universities are becoming sources of good startup deal flow. And they're trying to figure out how to be more efficient in identifying and finding those good ideas and opportunities. But despite these interests and willingness to go earlier, the CBCs, alone often can't partner with the earliest startups. Because the corporate venture capital teams are relatively small and spread thin, they have trouble with, very young teams or teams that haven't developed much yet because of the kind of the heavy engagement that's often required to create successful partnerships. So how do we kind of help bridge that? So let me talk about venture capitalists. What we're looking for are business opportunities that can grow up to generate real wealth for the business and for its investors and its employees and founders. We want to see evidence of a large and growing market to create that wealth in. We want to be able to believe in the team's ability to execute, so we look for experience and talent and how we would build the team. We want to find sustainable advantage in intellectual property. And we're really looking for signs of success. What are the signs that we can count on or use as leading indicators to warrant an investment in a developing opportunity? So that often looks like, early traction that demonstrates a customer willingness to pay and a successful business model. Revenues are a pretty key indicator. And then we want to be able to envision a path to liquidity, to an exit, and with a great return. And so when we're looking at very early stage opportunities that may not yet be showing much in terms of those signs of success, corporate interest, expressed interest, can really help motivate us as to the, in terms of those early indicators, and motivate us to get more involved. And if we do, then we can bring a lot to help develop those opportunities. Obviously, we can bring capital; it's core to our business. But we roll up our sleeves, and we can really help build out teams, bringing in the additional expertise and experience to help build a successful business. We've invested in and been part of a lot of different businesses, so we can be pretty helpful in terms of advice on strategy and how to move your business forward. And large part of our value proposition is through our experience of investing and working with different companies is creating a great network that we can help bring to bear for business development and growth. So, if we can get engaged early, we can help build a business. Sometimes, the university startup may be looking for a little bit more help to bridge the gap to a VC and or corporate interest. And I'll put in a plug for NSET 2 and what they're doing with the startup development officers. I think it's a great idea for assisting startups in their program, to help move them through milestones to a market event, whether that be the signs of success that we're looking for or the connection with a corporate or VC. The startup development officers that NSET 2 is bringing together, our former Fortune 500 executives, their angel VC investors, or their serial entrepreneurs, but a mix of people who understand and have a lot of experience in this space. and they can work with the universities to create startups, help with the licensing of the IP into the startups. They can sort of bring on student researchers and postdocs into the startups. They can facilitate and help faculty in their involvement. They can help do some early team building. They can help facilitate the relationship with corporate partners, set up funding milestones, help attract, some of that early money, whether it be SBIR or angels or connect to VCs, and continue to be involved and advise the startup companies. So I think there's really an opportunity here to combine the resources and characteristics and contributions of university startups and corporations and VCs, in a kind of a trifecta where we have a win-win-win with each of those organizations or entities. So with that, let me thank you and ask if there's any questions.
Thank you, Steve. At this point, if you have any questions, please feel free to enter them in the chat box in your control panel. You just pop them in there. We'll put them together and answer them. Steve's going to stick around and answer those questions for you. We also have Vicki, who's available as well. As a reminder, we are recording this, and you will be able to view it again on YouTube in a day or two after it gets posted. It is, and you can reference it or send it along to anybody else who you think would be interested. Okay, so we're ready for our first question. I have heard that angel investors are more likely to invest in university startups spinouts. What is your experience? How many startups do you have in your portfolio that originated in universities?
I have, so I have, I'm very interested in technology commercialization. I like strong, IP-based innovations. And I have done probably a handful of university-based startups or spinouts, and I've done actually, given my history, a lot of corporate technology startups and spinouts. So I have a good amount of experience with this. Certainly, I also find sometimes there are some great ideas or opportunities that are still a little bit unproven to me or don't quite have those indicators that I'm looking for. And I'm happy to get involved and help sort of give some coaching and make some introductions to, for example, potential customers or partners or corporates that I think can help a startup develop and become, an opportunity that I want to invest in.
Great, thank you. How does one identify VCs willing to work with a licensing model? Clearly you are one. However, our experience has been that everyone wants to own the IP, and that is incompatible with the licensing model.
Yes. Well, there are a lot of different kinds of licensing models. Yes, I would say in general, VCs want to own the IP that's core to their business and know that they can defend it. VCs want to, be able to obviously develop, additional IP, and VCs are generally much more interested in an economic arrangement that is sort of an equity sharing and participation that shares risk versus a royalty model. I've seen, I've negotiated probably 100 IP transactions in my life, and so I've been able to either find a way to transfer core IP, perhaps with a default fallback if the business doesn't succeed, or a contingent ownership or buyout, as long as the business succeeds over some milestones. I've been able to, have some rights to defend that transfer with the IP. So there's a lot of different ways to address the notion of ownership. And then obviously, as an investor, we're keen to have, once the startup is formed and created, the startup to be creating additional IP that it does, clearly own outright, that isn't just licensed. But I've been able to, let me put it this way, in the deals that I've done, I've never not been able to do a deal because we couldn't come to agreement on the IP transaction. I've always been able to work through that, if I was excited about the business opportunity.
Great, thank you so much. For our next question, you specialize on the East Coast. Do you have any affiliates that are West Coast centered?
I have no affiliates. We are focused on investing on the East Coast, but obviously the Silicon Valley and broadly the West Coast has been kind of the epicenter of venture investing, and probably has, the Silicon Valley alone probably represents about a third of the venture capital money in the U.S. now. A lot of corporates have set up their corporate venture capital arms in the Silicon Valley, and there's a lot of interest in technology-based opportunities out there. So they're not too hard to find.
Great. Our next question is 10-time return in 3 to 5 years is fairly tough unless we have a jackpot. Is this requirement firm?
Yeah, from a venture capital perspective, especially when you're investing very early, so therefore, there's significant risk that the business will be very successful. We want to go in thinking, there's a potential return here that's on that order. And we know that, in the end, the statistics are, if we make 10 investments, we're happy if, 1 or 2 of them achieve that kind of success. But we don't want to go into a deal unless we can envision that kind of upside opportunity, generally.
Thank you. And our next question is, Steve, the presentation was great. From his experience, commercialization R&D is more risky than stable markets. Stable markets have hurdle rates of about 12%. What APR is well received by front-end R&D investors? What horizon do they prefer? 4 years?
Yeah, I think, well, first of all, it's funny you say stable markets have hurdle rates of about 12% when, you can invest in, pretty safe fixed income at, 1 or 2%. So I think 12% would be a pretty exceptional return in current markets, other than maybe last year's S&P 500. But so I think 12% is still a good hurdle rate. A lot of VCs, talk about, if you can return, 20% IRRs, you're doing great. And but the reality is, if you're in the teens, you're probably being pretty successful relative to other assets. And in terms of horizon, we love it when we can get into a deal and have an early win and be out in 3 to 5 years. But the reality is, 5 to 7 years is a win. And I think the statistics show that the average time from first investment to exit is closer to 7 or 8 years. So the reality is, your big wins, are normally in the kind of 5 to 7 year, with maybe a real outlier earlier than that. And then your average exits are in that sort of 5 to 10 year range.
Thank you. Do you prefer a sustainable business model or a very cool exit plan strategy when choosing for investment?
I like to go into a business that I think can grow as a sustainable business. I think those businesses tend to have more upside and more exit opportunity. Those are obviously the ones, most exits in the venture capital world are M&A exits, probably 80 or 90%. But you want to invest in businesses that you could think, this could be a public company. So definitely preferable. But sometimes we do go into deals, with, for example, especially if you have a corporate involved early and you see a clear fit, there may be, a view that with the right proof points, there could be as you say, a very cool exit plan early on.
Thank you. How do you evaluate quantitatively clear disruptive technologies?
Yeah, it's if I understand the question right, we'll try to envision kind of let's say we know that more than say a year out, you're getting pretty speculative when you're an early stage business. So we try to do really just kind of back of the envelopes in terms of how big a market do we think could be created by a disruptive technology. We try to think about the existing value chain and its cost stack and how might that change or be disrupted by a new technology. And then, of course, how broad a market that might apply across. So we try to just do some back of the envelope triangulation on how big an opportunity we think something could be in terms of revenues or value add or cost takeout or something like that.
Very good. Thank you. You have another question. Hang on here. Let's pull it up.
Oh, it's a long one.
Yeah. All right. What are the indicators you are looking for in tech opportunities coming from universities?
Yeah. So the best ones are real signs of interest or traction in the marketplace. So I think universities are getting better, with their incubators or co-working spaces or accelerators, and often EIRs at the universities, or if you sort of leverage the like the NSET2 startup development officers, they're getting out and doing customer interviews, trying to create indications of interest in the marketplace. So I'm looking for that, and the more real those are, the better. So I would like to have references, folks that I could talk to or data that I could get from customer interactions. I'd love to see the stronger kind of intent to purchase and understanding of what they'd buy is helpful. So the more engagement from customers or corporate partners, that's the most important. And then the other indicators are, probably relative to the team and what I think the team can do. So, certainly, what I see them doing in terms of developing their product, in terms of getting out in the marketplace, maybe in terms of other past experiences or other startups they've been involved with, the things that give me some confidence in investing with a team.
Thank you. Our next question is, other than equity stakes, what other revenues sustain your efforts? Corporate subscriptions, seminar fees, consulting fees, challenge fees?
I'm a pure venture capital fund. So our economics are based on investing the fund, and we're really money managers. So we are paid a small fee out of the fund to sustain as you put it, sustain our efforts to kind of pay our day-to-day expenses. But we're really looking for the investments from the fund in acquiring equity stakes to be the return that we offer our investors, and and participate in our success with them.
Very good, thanks. Our next question is, can you discuss any advantages or disadvantages associated with working with European-based university startups?
Yeah, I've done a few European-based university startups. I find it, I guess, very similar. I think there are some great research universities in Europe. I think there are some universities in Europe who are just as motivated and doing a good job of creating a startup ecosystem, with everything from local entrepreneurs and investors and incubators of their own. I found probably the same kind of mix of perspectives and approach to licensing IP. I found sometimes the IP sometimes there are university IP ownership structures that are a little bit different than the way IP is owned by universities in the US. And of course, the IP in universities in Europe is, they may or may not have filed in the US. They may have filed only in Europe. So there's some of that to figure out. But no, I think it's probably pretty similar in general.
Thank you. All right, we have one final question. Have you seen large corporations that are less honest and try to take away the startup's IP through CBCs? They may know more about the potential of our technology and file their own patent.
Yeah, those charges were, there were anecdotal stories and those charges levied, I'd say, longer ago than I see today. I think, for the most part these days, because the corporations have learned over the years that working in venture capital is these are long-term investments, long-term relationships. You have to build, a trust in the VC marketplace to be successful. Many of the people now doing this in corporates, I think in 10, 15 years ago, the corporate CBCs were often, a few year rotational positions for people inside the corporates. I think now they understand that the teams need to be longer term committed and involved, and you're seeing professionals who are making their career about being in the corporate venture capital group. So they don't want to risk impairing, their relationships and their trust in the community. So the bottom line is I see less and less, risk of that these days. But that's not to say, most corporations, when they first hear about an idea, they want to hear it without having to go through an NDA process. And so you should share what you can share without an NDA. And then, if the relationship and interest develops, then, it's time to make sure your IP is solid and or ask, the corporates to sign an NDA when they're digging in.
Great. Thank you so much, Steve, for answering these questions and being part of our webinar today. As a reminder, we will have another webinar in 2 weeks on February 28th at 1 o'clock Eastern Time with David Horowitz, the CEO and founder of Touchdown Ventures. You can watch this one in another day or two. It'll be posted on YouTube, as well as all of our old archived webinars. They're all available there on the YouTube link. A reminder that registration is now open for the University Startup Conference and Demo Day. There's more information to be found on the NSET2 website. And if you're interested in submitting IP or startups to be reviewed prior to the Demo Day, please note that the Submission deadline is March 2nd. If you do have any questions, please feel free to find more information at NSET2 or to reach out to us. And if you will be at the autumn conference next week, we do hope that you'll stop by our booth 715 to talk to us. We'd love to hear from you and answer any questions you have in person. Again, thank you so much for being part of our webinar today. We hope that it was beneficial for you. If you have any questions, please feel free to reach out to us. Have a great day, everyone.